Okay, guys. So I'm just gonna start off, and as I said, that what we should be doing is that we should try to do the past examination questions. So I'm gonna start off with this September, December 2024. I'm gonna start off with this September, December 2024. Okay, so September, December 2024. Let's just try doing it. So we're gonna start off with question number 1. We're gonna start off with question number 1. So the question number 1 from the section A. This question is actually about the consolidation. What exactly is the requirement of this question? Using Exhibit 1 and in accordance with IFRS 10 consolidated financial statement, explain why layout does not control Brossoik company. Explain why layout does not control Brossoik company. That's one of the things that you have to do. You have to give an answer to this one. Number 2, explain with appropriate calculations how defined benefit plan should be accounted for in the year ended 31st December. And then Exhibit 2 and 3, adjust the pre-populated response sheet option to correct the draft consolidated statement for the following facts. Brassoik is an associate and not a subsidiary, and the defined pension plan has not been correctly accounted for. So first of all, what I'm just gonna do is that I'm gonna open up an Excel file so that I could just share the answers with you people also once we are done with this. So Excel file is what I have actually shared. Now, this is the examination September, December 2024. September, December 2024. And this is basically question number 1. The name of the question is Brassoik company. Now, the requirement of the question is using Exhibit 1 and in accordance with IFRS 10, why layout does not control Brassoik. So give it a try. Just read through this part and let me know what do you think should be the answer. It's an 8-mark requirement. Yeah, what do you think should be the answer to this one?
Well, I don't think it's supposed to be treated as subsidiary because I cannot see a control.
Okay, let's see. So on 1st January 7, on 1st January 7, Layout Company acquired 45% of the equity share capital in Brasioc Company, a private company. On the acquisition of 45% equity capital, Layout Company could appoint 5 of the executive director and 4 of non-executive directors. There are 12 executive directors, so you can appoint 5 of executive out of 12 and 7 non-executive directors which comprise Brasioc board of directors. Executive directors make all key business decisions by simple majority. Non-executives help in strategic development of the company and provide advice to the executive directors but cannot vote on business decisions. The directors appointed by Layout Company always vote in line with Layout Company's policies. The other 55% of the shares are owned by single private investor who can appoint the remaining 7 executive directors and 3 non-executive directors. During the year, Layout entered into a forward contract to purchase an additional 10% of the equity capital of Brasioc on October X8. When exercised, this will not change the number of directors which Layout can appoint. Layout believes it controls Brasioc. So Layout actually during the year ended 31st December 7, Layout entered into a forward contract to purchase an additional 10% of the equity capital of Brasioc on October X8. When exercised, this will not change the number of directors which Layout can appoint. Layout believes it controls Brasioc and has accounted for Brasioc as a subsidiary in its draft consolidated financial statement. Now something that I need to talk and that I need to discuss, let's just talk about it. So now we just need to talk about it that whether it's a subsidiary or not. So see, how would you give the answer to it? First of all, you would say what is a subsidiary? A subsidiary is an entity that is subject to control. Control is the power and ability. The control is when all the following conditions are met. Power to direct relevant activities of the investee, ability to exercise power, having power over investee. Now, the power is mainly obtained by the fact that you are able to appoint majority directors to the board. The non-executive directors are only engaged in strategic decision making the entities do not have the voting rights. The voting rights are with the executive director. Out of the 12 executive directors, is only able to appoint 5, which means that it does not have the majority directors. The forward contract to buy additional 10% holding is a potential voting right. The potential voting rights are also required to be considered when making an assessment if the control exists or not. Okay, so also required to be considered when making an assessment if the control exists or not. Right? Now what next is there? So, however, the additional 10% shareholding will also not provide the ability to appoint majority directors, and hence the control will not be exercised. Therefore, there is no control and it's just a significant influence that is present. Therefore, this investee is not to be consolidated but rather to be accounted for using equity method of accounting. Okay, let's move a bit forward and let's talk a bit further. There is this pension plan. Let's talk. Can you just go through it and see what needs to be done on this? Okay, let's see. So it says at 1st January 7, the defined benefit pension plan of Layout Company had a net deficit of $24 million. So what did it add? It had a net deficit of $24 million. The actuary has provided the following information for the year ended 31st December X. The current service cost, the cash contributions into the plan, plus what happens is there is this net deficit at 31st December X. Then it says at 1st January X7, the interest rate on high quality corporate bond was 5%. Was 5%. Then it says on 31st December X7, the pension plan extinguished its obligation to 250 ex-employees by paying 60 million out of its plan assets to another pension provider. This reduced the present value of the obligation by 50 million. So this is the curtailment. After the above events, the actuary valued the net deficit at $40 million at 31st December X7. Only accounting entry was to recognize cash contributions, so and so, so and so. Now, what do we have to do? We have to actually they do the accounting for the pension plan. How are we going to do the accounting for the pension plan? Let's just try to see this thing. We're simply going to do it like this. We're going to say, okay, opening defined benefit liability. So that's basically 24 million. Then what is actually happening is that interest expense at the rate of 5%. Then what happens is that current service cost is 6. Then what actually happens is that loss on curtailment is gonna be 60 minus 50. Cash contributions paid is 4 million. Then there is this net remeasurement, gain and loss. Then there is this defined benefit liability closing, which is gonna be 40 million. So 2.8 million is what it is gonna be. 2.8 million is what it is actually gonna be. So what happens is this goes to PNL, this goes to PNL, this goes to PNL, this goes to OCI, this goes to balance sheet. Okay, the loss on curtailment is simply you paid 60 million of assets to settle 50 million of liability. So technically you had a 10 million loss. Yeah. So basically, this is what it is gonna be. So if I'm gonna talk about the correcting journal over here. So they have only recognized this 4 million into the P&L. So it actually say the OCI is gonna be debited by 2.8. Defined benefit liability is gonna be credited by this 40 minus 24, and the P&L has to be debited by the difference, which is 13.2. The P&L is to be debited by 13.2. You still don't get the loss on curtailment 10? Okay. Now let's just go back to the question. Can you just read through this part? Okay, so we are done with this part now. You could just go on to do this on the spreadsheet. You could probably apply this in the spreadsheet, because on the spreadsheet, you have to actually do it this way. So what they have done is that they've probably consolidated it, right? Have they, or what they have not? Okay. Now, acquisition of Brassioc, they have probably calculated the goodwill here. So you have to establish that what goodwill have they calculated, and then you have to establish that what is the value at which the investment in associate is to be shown. Okay, now let's see. It says on 1st January, X7 Layout Company acquired 45% of the 10 million $1 equity shares of Brassioc Company. This gave Layout Company significant influence over Brassioc Company. However, the investment was incorrectly classified as a subsidiary and accounted for using the acquisition method in the consolidated financial statement. When calculating goodwill on 1st January 7, the non-controlling interest was measured at fair value of 51 million and fair value of identifiable net assets was 83 million. Purchase consideration comprised cash of 35 million. So the purchase consideration comprised cash of 35 million. On 1st January 7, Brassioc had retained earning of 39 million and other component of equity of 3 million. The difference between fair value and the carrying amount in the individual was attributed to PPE, which had a remaining life of 5 years at the acquisition date. The individual financial statements of Brassioc Company at 31st December 7 is presented below. The assets are given, the equity is given, the liability is given. Now, did you people calculate the goodwill? Yeah, did you people calculate the goodwill in this? Okay, let's see. So if I talk about The goodwill at acquisition, the cost of investment was $35 million. The non-controlling interest was $51 million. The fair value of net assets included what? Share capital, other component of equity, retained earning, fair value adjustment. $10 million. Another component of equity was the fair value adjustment is, then it says the fair value of identifiable net assets was 83 million. 31. So the goodwill is going to be like this. The goodwill relating to it is 31 million. 3 million. So the goodwill is 3 million. Then the excess depreciation that has been charged is, let's say, 31 divided by 5 is equivalent to 31 divided by 5. So the excess depreciation is 31 divided by 5. Right? So the excess depreciation is 31 divided by 5. Now, so when we are going to be doing this, so what we need to do is that we need to talk about investment in associate. The investment in associate is going to be like this: cost of investment. The cost of investment is 35. Add share of post acquisition reserves, OCE, retained earnings. So OCE today is 3 million and it was 3 million earlier also. The retained earning is right now 55 and it was 39. 45% acquisition, 45% acquisition. Resultingly, this is what it is gonna be. This is what it is gonna be. Hence, we have 42.2. We have 42.2. right? Okay, we are computing the goodwill when there is no control because he has actually consolidated this subsidiary and we got to do adjustment to it. So like we would do this adjustment like this and we would add up 42.2 over here. That's what we are going to do. So we're going to do the adjustments over here. We're going to deduct 31 plus 6.2. So we're going to deduct this also. So that's what we have to do. We have to do the adjustments. We have to do the adjustments. That's why we are doing it. We got to do the adjustments. That's why we are doing it. We also need the NCI at year end. Consolidated retained earning at year end. Acquisition date NCI is 51. Share of post acquisition reserves is equivalent to 45% multiplied by we have what we have it right now of we being told that it is 55 minus 39. So the non-controlling interest would have been this. So 59.8 is the non-controlling interest here, and we got to remove this 59.8 from the non-controlling interest also. We got to remove this 59.8 from the non-controlling interest also. And we got to remove it from the retained earnings too. So that is what we have to do. We got to remove, this is what we are going to do. Right? All good? Okay. So this is how you will adjust it. Now let's move on to the next question, which is question number 2. So it says Apaneva is the parent company of a group. The financial year end is 31st December X7. Following exhibits available on the left hand side of the screen provide information relevant to the question. The statement of cash flows, the ethical issues. The question says describes. The question says requirement is using exhibit number 1. Discuss the correct presentation of the following issues in the consolidated statement of cash flows, the 1.1 million net movement in long-term borrowings and the high interest bank account. Using exhibit 2, discuss the ethical issues, so and so, so and so. A statement of cash flows. Let's just try to see that how this should be presented in the, let's just try to see how these should be presented in the statement of cash flows. How these should be presented in the statement of cash flow. Okay, so first of all, it talks about the long-term borrowings. Now, it says in Apaneva Group's financial statement for the year ended 31st December X7, the long-term borrowings were carried at $21.1 million. Following information was extracted from the financial records 31st December X6, receipt payment, acquisition of subsidiary, new leases 31st December 7, bank loans, lease liability. Next is basically a subsidiary was acquired in September X7. At the acquisition date, this subsidiary has a bank loans with a carrying amount of $1.5 million. Then it says on 1st January X7, Apaneva entered into a contract to lease a building in accordance with IFRS 16. A lease liability and a right to use were recognized at 8 million. In the consolidated cash flows, Mr. Lennox reported the net difference between opening and closing of 11.1 as a single cash inflow from financing activities. So now how exactly are we going to be recording it? That's something that we need to discuss. So let's just talk about it, that how are we going to show all of it.
And 9, 8, 7, 10.
Now let's see. So how do we actually go about it? Try understanding some. Question 2. So the bank loans, receipt of 2.5 million, outflow in financing, subsidiary 1.5 not shown. Then that's it, right? So 2.5 million relating to bank loan has to be shown. Then similarly, with respect to the lease liabilities, payment of 0.9 million shown as an outflow in financing, and then new lease of 8 million is ignored. Hence, total financing cash flow is gonna be 2.5 outflow plus 0.9 outflow. Sorry, this is inflow. So financing cash flow is net financing cash flow is 1.6 million. This is to be shown. So the net financing cash flow is 1.6 million. This is to be shown. Right? So all good. This is what you have to show. Now what next is there? High interest bank account. On 1st November X7, they paid $4 million to a high interest bank account. Cannot withdraw the funds before 30th April X8. The money in this account has been treated as cash equivalent in the consolidated cash flows because Lennox believes that bank would release the funds early if FNMA was suffering from liquidity issues. So no, this should not be shown in the cash equivalent. This should be shown as an investing activity. High interest bank account to be shown as investing activities. It should be shown as investing activity formally. Outflow. It should be shown as an investing activity, 4 million outflow. Right? All good? Okay. Now let's move a bit forward and talk about the ethical issues. That what is the ethical issues that we need to actually consider? The requirement is using exhibit to discuss ethical issues and the actions which Mr. Lennox should take to address these. So what are the ethical issues and what actions should be taken?
हमने बोर्ड देखा है हाँ हमने बोर्ड मार्कर आप लाइट मुझे बोर्ड में देखना बोर्ड घूम गया
Yeah, what do you think should be done, please? Yeah, what do you think should be the ethical issues in this one, please? Okay, let's see. Mr. Lennox is an ACCA member and Ms. Ruiz, the finance director and an ACCA member, is his immediate line manager. So one of them is an ACCA member. The line manager is also an ACCA member. Ms. Ruiz has ordered Mr. Lennox to produce Apaneva Group Sustainability Report in accordance with IFRS Sustainability Disclosure Standards. Mr. Lennox has never produced a sustainability report before and is unaware of the content of these new standards. Ethical issues. Unaware of the content. After correcting errors outlined in Exhibit 1, Mr. Lennox sent consolidated financials to Ms. Ruiz for review as part of a review. Made several changes. Mr. Lennox believes Ms. Ruiz has understood the foreign exchange laws adjustment in arriving at cash flows from operating activities and also understated dividends paid by 2 million. Okay. Dividends paid understated. Understatement of the foreign exchange losses. These combined errors have no impact on overall net cash flow from operating activities. Lennox is aware that Ruiz is a major shareholder and because of the current liquidity, he has concluded that she wants to conceal from third parties the extent of her dividend. Okay. In the past, Ms. Ruiz is a major shareholder. Ms. Ruiz has threatened in the past when questions are raised. So now what to do and how to go about it. Okay. So basically what happens is lack of professional competence and due care, integrity, intimidation threat, self-interest threat involved. So what you have to do is that you have to consider reporting to those charged with governance. If appropriate action not taken, resign, seek legal advice. If the matter to be reported to ACCA. So that is what you have to do. This is what you have to do. Okay, so what I'll just do is that I'll take a short break and then I will just resume. So when we start, we will be talking about next questions. Okay, let's begin. And let's take things forward. So we did question number 1, we did question number 2. Now move on to question number 3. So this is question number 3, Sial company. The question's requirement is basically the multiple requirements to the question. It talks about bundled goods, discontinued operation, land, option to purchase a building. Now requirement is using exhibit number 1 and in accordance with IFRS 5, IFRS 15, discuss how Sial company should allocate the transaction price to the hardware package sold to heat company, show all the calculations. So question number 3. Okay. Exhibit number 1. Can you just go through it? Can you just try doing it, please, in accordance with IFRS 15? Take 5 minutes, then I'm going to start discussing. Okay, it says CL company entered a contract with a customer heat company to sell a hardware package comprising a computer, a monitor, and a printer for $2,000. CL company will supply each of the three products at different points in time according to the needs of the customer. CL company regularly sells the computers separately for $17-20. However, the monitor and printer are the new models and are not yet sold separately. CL company knows that competitor companies sell a similar specification of printer for $180, which CL company feels reflect the entity's cost margins. The cost to produce a monitor is $150. CL company achieves a gross profit margin of 25% on the selling price of its products. So how exactly are we going to do this? Let's try understanding this thing. So you would allocate on the basis of standalone selling prices. They allocate on the basis of standalone selling prices. Now what else is there? So if we talk about, so the computer is normally sold for $17.20. Printer is $180 and monitor cost us $150, but we usually sell it at a 25% gross margin. So $150 divided by 75%. So hence resultingly $2,100 is the total amount. You compare it with now the bundle sale is for 2,000. So the discount is this minus this. So how much discount to be allocated? So it is actually going to be 100 multiplied by I'm going to log this cell. I'm going to log this cell. So resultingly, net price after discount is going to be this minus this, and the bundle becomes 2,000. And the bundle becomes 2,000. So basically, this is how the price has to be allocated on the basis of standalone selling prices. So I just established the discount and I allocated the discount accordingly. I just established the discount and I allocated the discount accordingly. Let's move a bit forward and let's discuss further. We talk about discontinued operation. So when we talk about the discontinued operation, what is it gonna be? Just try understanding this. Can you just go through it, please? Okay, it says during. So now the question's requirement is using Exhibit 2 in accordance with IFRS 5. Discuss whether profit on the sale of license should be presented as arising from discontinued operations in the statement of profit or loss. Now, what do you mean by discontinued operation? Discontinued operation is component of an entity that has either been disposed of or is classified as held for sale and represents separate major line of business or geographical area of operations or a subsidiary acquired exclusively with the purpose of sale. So here let's see. During X7, Sial company purchased and then subsequently sold a license. The income it generated was small in the context of overall business. Sial regularly buys licenses with a view to reselling them. At any point in time, it owns several software licenses. Profit on the sale of the license was presented as arising from discontinued operations. In the statement of profit, this was because Sial believed license was a separate component of the business. So, license, sale, and purchase is the regular feature of Sial business. Therefore, the license does not meet any of the above criteria, and hence license cannot be classified as a discontinued operations. License be instead accounted for under IAS 38 intangible assets. So it's not something that's a discontinued operation. Right? Okay, now next. Let's talk about the land. Let's talk about the land now. So can you just go through it? What is the requirement? It says using exhibit, discuss how land and its fair value should be accounted for in the year ended 31st December X7. Okay, can you suggest how the land should be accounted for? Okay. It says on 31st December X6, Sial company acquired land for $10 million. The intention was to turn it into an employee car park. Cost of this land was recorded as a PPE. By 1st September 7, the land had not been developed into a car park. Many employees had started working from home, meaning that car park was no longer required. On Sial company decided. So what happens is that Sial classified the land as investment property and measured it at the original cost of $10 million. Sial company wished to use the fair value model in IAS 40 investment property. However, as at 1st September 7, Sial company believed that it was impossible to measure the fair value of the land due to legal complications concerning public access. A nearby plot of land of very similar size with similar legal complications sold in September for 11 million. On 31st December, legal issue was resolved. Sial hired a surveyor who stated that it had a fair value of 11.5 million. At this date, Sial calculated fair value gain of 1.5 million, the difference between 10 million purchase cost and its fair value of 11.5 million. This gain was recognized in the statement of profit or loss. So now, what do we have to do? How do we have to measure it? Let's try understanding this. So basically, there are multiple things. It was classified as PPE as it was held for administrative purposes. On 1st September X7, the purpose was not defined and hence it cannot be a PPE. It shall now be considered as investment property. Shall now be considered as investment property. Shall now be considered as investment property. The fair value of the investment property to be determined using the guidance available under IFRS 30. As per the guidance, the most recent transactions of the similar type of properties would define the fair value. So most recent transaction of similar type of properties would define the fair value. So the fair value should be assessed to be $11 million, and the fair value should be assessed to be $11 million, and the difference between the cost and the fair value is to be treated as the revaluation gain under IAS 16. This gain of $1 million is to be recognized in the property plant in the OCI. The subsequent remeasurement to the fair value of $11.5 million is under IAS 40. The difference between carrying amount of $11 million and $11.5 million, the fair value shall be recognized in the income stream. So the gain of $1.5 million recognized in the P&L to be adjusted as a reduction from the P&L and recognition in the OCI. This is how it has to be done. Yeah, this is how it has to be done. right? Okay. Now what else is there? There's this last part of the question, which is option to purchase the building. Now, can you try doing this one, please? Okay, the functional currency of Sial is the dollar. On 1st December at 7, Sial paid 10,000 dinars to a property developer for an option to purchase a building situated overseas at a fixed price on 1st July exit. Option to purchase is a call option. The payment is non-refundable. Believes it is highly probable it will purchase the building. Sial proposes to treat the contract as a derivative financial asset measured at fair value through profit or loss in its financial statement for the year ended 31st December X7. So they have an option to purchase. They have an option to purchase. What do you think should be the answer to this? The requirement is that discuss how the payment required to acquire the option should be accounted for. Yeah, what do you think should be done? Okay, now see, what actually happens is that so for the definition of the derivative, for the option of the derivative, for the derivative, what actually happens is that an option to buy, an option to buy a non-financial asset that will be physically settled is outside the scope of IFRS 9. The building is non-financial asset. The contract will be settled by the transfer of the building. Hence, no net cash settlement. Therefore, based on the above, it cannot be a derivative contract. This is to be treated as an advance for the property and recognized as a prepayment. Once the property is bought, this prepayment is transferred to the PPE account. In case if the property is not bought, then the prepayment is expensed to the P&L. So this is how you will account for this specific scenario. This is how you will actually record this specific scenario. So this is the approach that is going to be there. Right? All good? Okay, all good? Okay, great. So we're gonna keep it till here now. And we will have one more session. I will update you the date when we will have that session. So, but that's it for the time being. And the recordings will be uploaded. Plus, in addition to this, this is also going to be updated. The notings are going to be shared with you in the uh, WhatsApp group also.
Okay.
Right? Thank you, guys. So thank you.
Bye.